Hello, chart watchers, and welcome to this Wednesday, March 21st Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the action today in the market's been pretty good so far. We got the Dow Jones Industrial Average up 118 points. The S&P 500 is up 11. NASDAQ bouncing back up 25 points. And the Russell 2000 leading today up almost 1% today, up 13.67 points. The 10-year Treasury yield moving to its highest level in March as we approach the FOMC policy statement coming out at 2 o'clock this afternoon. Volatility index on the decline again, back down to 17. It's down about 6% today and down about 5 points from the high that we saw just 2 days ago during the selling on Monday. The energy space bouncing nicely. We've talked recently about crude oil, how it's been moving up. The XLE has not been following suit. Well, it's playing a little bit of catch-up today, up over 2%, actually up over 2.5% today, having a very strong move to the upside. Oil equipment, you can see challenging recent highs. This is the best industry group within energy today, but that 420, 425 area has been a brick wall to get through. We'll see if we can get through it today. Home builders back in the news today. Existing home sales came in better than expected. We'll talk about that in a bit, but you can see the home construction group moving higher today. Helping to lead consumer discretionary. And then delivery services. FedEx reported overnight, and you can see that this group is being lifted, no pun intended, by FedEx. And consumer staples, the weak link, moving down, testing a really key area of price support. I think we could begin to see the relative weakness level off in the XLP because we are hitting some key support. We'll talk about that in a bit, but tobacco stocks have broken down. And the move to the downside has been very swift. You can see over the last 8 or 9 trading sessions, this group's down over 10%. So even though the market's been trying to rally back, tobacco has not. I'd like to say, Erin, that it's getting smoked, but that probably wouldn't be a good choice of words. How are you doing today, Erin?
I'm doing great this morning. How are you?
Oh, I am doing just fine. We got another great show lined up. We've got David Keller with us today. Can't wait to hear his presentation. How are you doing this morning, Dave?
I'm great, Tom, Erin. Good morning, good afternoon. Pleasure to be on with you guys. Excited to be part of it. Thank you.
Yeah, I mean, we can't wait to get your perspective on this crazy market that we've been going through, the roller coaster rides and a lot of the triangle formations and everything we've been going through. We've seen, the NASDAQ break out. We see Facebook, though, giving it back and breaking down. So it'd be interesting to see your take on everything that has been happening in the market. We're looking forward to that in just a bit, maybe 10 minutes or so. And with that, Erin, I think maybe if you want, just go through the weekly announcements and the agenda, and we'll get going.
Yeah, let's do it. We've got a lot to go here, and we certainly want to give David plenty of time. So as far as the weekly schedule, we just have coming up Friday is Tom's workshop on reasons to sell. So that should be a really great presentation. I know you guys ask about that all the time. Today's agenda, though, we have, as we've said, David Keller's going to start the show off with after our technical news, followed by our 10 and 10 to 1, where our first symbol will be SkyWest. And you might want to go check that out before Tom does. And then finally, we're going to end with an actual mailbag segment. So we've pulled a bunch of questions from your comments in the live chat room and additionally from our survey responses. And we're going to ask and answer quite a few of those questions. So stay tuned for that. And with that, I'm going to pass it back to you, Tom. Let's get into some technical news.
Sounds good. Got a lot going on today. We do have, of course, the Fed meeting coming up at 2 o'clock Eastern this afternoon. So that is just a little less than 2 hours away. Traders may be sitting on pins and needles to see what the Fed has to say. I think everybody, just about everybody, I would say, is expecting a quarter-point rate hike. So I don't think that is going to shock anyone, but I do think that the language that's used is something that we always focus on each meeting, and it will not be any different this meeting, especially given all the volatility that the market's seen over the past 30 to 60 days, and with inflation, that bad inflation word coming up recently, seeing some higher than expected readings in some different areas. So how the Fed is looking at inflation, I think, is going to be a big piece of this report. But you can see the 10-year Treasury yield this morning is jumping. We are up back over 290, so we're up about 2.5 basis points. We did get the February existing home sales in at 10 a.m. this morning, 5,540,000 units. The market was only looking for 5,420,000 units. So we've recently had some economic news in housing that hasn't been so great, but today it was very strong, and we're getting a nice response in some of the housing areas. So I thought first where we would start is just looking at that home construction index. That's the $DJUSHB, and you can see beautiful move up today, up 2.2%, so clearly an outperformer. But there's a lot of work to be done here. You could look at this maybe as a top followed by left shoulder, left side of the neckline, lower low prints the inverse head. We move back up, have slightly downtrend or down sloping neckline. I would prefer slight up sloping neckline. I think that gives it just a little bit more of a bullish angle to it. But nonetheless, if we were able to get back up and take out that third week of February high around 880, you can see that also would likely take out the 50-day moving average, and I think that could get things started. We do have a positive divergence in this group. As you can see, we put in the lower lows to end February and to start March, and that came with a higher PPO reading. So it looks to me like momentum to the downside is slowing. The existing home sales report that came out this morning will not hurt, and so far we're getting a pretty positive response to that, which I think is a good sign. So home construction, I think, looks pretty interesting here. Let's take a look at the industrials. Let me pull up the XLI first. It's not the leading group, but it is having a pretty strong day today. As you can see, it's up 0.72%. It does continue in what appears to me to be a triangle that we're seeing across many areas of the market. You connect these tops coming across, and you see a declining tops trend line. And here you can see the rising bottoms. And what we're doing is squeezing as we get further and further out here in time. We're looking to see which way this breaks. But it is, if we pull up a longer-term weekly chart, this is coming in after an uptrend, clear uptrend. So anytime you get some kind of consolidation following an uptrend, you expect that the resolution will be to the upside to follow that prior trend. And that's what I'd be looking for here. From a weekly perspective, check out the XLI and how each time we fall back, that rising 20-week moving average has been very strong support. And this dates back to when we crossed above the 20-week moving average back in early 2016. So this is a trend that's really been going on for more than 2 years in industrials. And here we are trading just a little bit above the 20-week. I think this favors the bulls. And so I would be looking for more movement to the upside. If we pull up actually, let me go to the daily chart. And within this group, I'm going to pull up $DJUSHV, which is heavy construction. And I see an inverse head and shoulder here as well. Left shoulder, neckline, inverse head, which is slightly lower. We come back up, and that 465 area, really 465 to 470, presents some overhead resistance. And that 50-day moving average is sitting right now at 468. So as we move back up again, this is going to be a chart to watch. I think if we break back through the 50-day with increasing volume, this will be an area of the market that you're really going to want to pay attention to going forward. Let's pull up delivery services. This is $DJUSAF. Here is the recent move higher. We are now trading currently at the highest level this index has seen since back during that initial sell-off in early February. So we are starting to strengthen here. And as I mentioned, FedEx reported last night. They came in with revenues of $16.53 billion. The market was only looking for $16.18 billion, and their earnings blew estimates out of the water, $3.72 versus $3.08. And in addition to all that, they also provided some upbeat guidance for 2018. So you combine all that positive fundamental news with this technical breakout above this reaction high at 255, above the 50-day moving average. We've been holding that rising 20-day moving average, which I think is very bullish. And check out the volume today so far, 2.4 million shares, with FedEx up over $5, clearing overhead resistance. Assuming FedEx finishes strong today, I think it's leaving its lows behind it, ready to move up and challenge the highs that we saw back in January. Of course, over time, I'm not looking for a straight up move, but I would not be surprised to see FedEx continue to hold the rising 20-day moving average, up until it gets to that 273 area. That's what I would be looking for with FedEx. Now let's take a look at some of the areas of consumer discretionary, the XLY. The XLY has been a great relative performer. I could pull up the XLY, compare it to the S&P 500, and after taking maybe a little bit of time off, I'm going to change the candlesticks to, no, I don't want dash line. Let's change it to a solid line, and let's go out, let's do weekly, and for the past couple years. Because for a while, the XLY was struggling. You can see this relative, I don't know, neutral, even the downtrend that we saw before late October of 2017. But since then, you can see this has been a big move up. Part of the reason is retail. Well, a big part of the reason is retail. We've seen the broadline retailers performing extremely well. Even some of the specialty retailers, the apparel retailers, clothing and accessories, all of these groups have actually started to perform much better. And it began for many of these groups back in late October, early November. And as a result, the XLY has broken out on a relative basis. Yes, we pulled back, but now we're moving back up and breaking out to new fresh highs. So I think if you're looking to outperform the benchmark S&P 500, one of the areas I think you really need to be looking at is in consumer discretionary, because the group is outperforming the S&P 500. Much easier to find stocks and areas of the market that outperform if you're in a sector that is outperforming. So the XLY, I think, looks really interesting. Mentioned the home construction group. Let's take a look at the autos. DJUSAU in a downtrend, but notice on the most recent low here, we have a higher PPO. Now, some of you astute technicians might look and say, well, we didn't print a lower low. Keep in mind that the PPO, the MACD, they're all based on closing prices, not intraday. These are intraday lows. If we switch over, and this is one of the few times that I like using a line chart. I like using it with relative charts, and I like using it as an educational tool for spotting these positive and negative divergences, because I think it's pretty clear we have a lower low in terms of closes on the auto index as the PPO starts to rise. So I think we're seeing a positive divergence here in the autos. I think that is a good sign for this group to perhaps outperform in the near term. Now, I don't know that this is necessarily a big long-term buy signal for autos. It may be, but what I would be looking for is maybe a more sustained move through that 20-day moving average, get back up to challenge the 50, maybe even the recent highs that we saw on the autos back in February, those reaction highs. So I could see somewhere in the 215 to 220 area. We're sitting at 205 right now. So I think that's something to keep in mind. And then if I pull this up, I'm going to actually move to a weekly chart. Just remember that 215, 220 overhead resistance, because if I pull up the weekly chart here, you can see that we are actually hitting some really key support. I would say 195 back in earlier in 2017, and then 200 over the summer was really good support throughout this uptrend. We've now moved lower with a negative divergence at the top, by the way, higher prices, lower PPO on the weekly chart. And that normally can present some problems for at least a couple of months, sometimes longer. In this case, we've been moving down most of 2018, but I do think we're putting in support here. And notice when you get a move back up with a declining PPO in negative territory, a lot of times what I look for is that declining 20 period moving average, in this case, the 20 week, and that's sitting at 215, or actually 215 and change. So that's very similar to what we're seeing on the daily chart. So I think the weekly is arguing for the same thing the daily chart is looking for, which is maybe another 5% or so upside in the autos from here. The let's move on to the media agencies, and actually I'm gonna stick with this weekly chart here. The DJUSAV. Now it's been striving to turn around off of this downtrend. You can see what appears to me to be a left shoulder, neckline, head. We came all the way back up to the 50-week moving average, put in the right side of the neckline. In this case, you can see actually we did move just above that prior high, which I think gives us just a little bit of an upsloping neckline. So that way, when you break it, you know you're also breaking price support. With a downtrending slope line, you can break that neckline and still not be above price resistance. But on this pullback, I'm seeing perhaps a right shoulder, which would be very symmetrical to what we saw here on the left side. And then a move back to the upside would be a very big breakout. So this is a group that has been underperforming for quite some time. I talked about this earlier in 2018. I've been seeing some underlying strength in this space. And one of the ways that you can actually trade is if you go into your industry summary group and under the consumer discretionary media agencies, if you click on this, it'll give you the individual stocks that make up that index. And then if you rank it by scooter, it gives you the best performers. I want you first to notice how 4 of the small caps are among the best performers within this group. I'm starting to see a lot more relative strength in small caps, seeing it again today. And as a result, we're beginning to see many of these small caps move up in their scooter rank. Quinn Street, I'm not going to go over. We've talked about this plenty of times in the past. I actually own this one. But I think a couple of other stocks in this space look really good as well. Axiom Corp, ACXM, huge move up. I'd wait on a 20-day test, but I think this one looks interesting. And then the last one, this is a company that came out with earnings recently, very strong earnings, and it's pulled back. And I think that this is presenting an opportunity here on IPG. Big breakout, very heavy volume. We got that shooting star candle right at the top, which marked a short-term top. We've pulled back. I think we're now testing an area of support. We might go down and fill that gap to 22. So I think this 22 to 23 area is a great accumulation area. I'd look for a return back up to 25, 25 and a half on IPG. And with that, I am going to bring in our great guest for the day, David Keller. I know David is a CMT and he's president of Sierra Alpha Research, and been looking forward to having Dave on the show. Welcome to the show, Dave. Looking forward to your presentation.
I appreciate it, Tom. Thanks so much. And as I mentioned when we all spoke the first time, Tom and Erin, this is such a fantastic show. I love it. I've been watching it myself, and I made the comment to you that if financial television was this, I think it would be really worth watching. So congrats on a really good job with this. I really enjoy it.
So very nice.
Yeah, very nice of you. Thank you.
Yeah. So I'm very excited to be with you guys. I've been writing for StockCharts.com as part of the Top Advisors Corner for a little while, and I've really enjoyed starting to get some of my thoughts out and share my perspective. My background, being at Fidelity and at Bloomberg before that, has really been with institutional money managers primarily. So with Fidelity, it was working with the portfolio managers that ran the equity mutual funds. We had about 75 PMs that we worked with, and really incorporating technical analysis, but also things like behavioral finance, data visualization, and sort of other related topics to help them, outperform as much as possible and minimize the downside risk. But what I'm hoping to share with all of you today and all the viewers is just some of the lessons I've learned, particularly the features of technical analysis. I've found that for a lot of people, technical analysis has very specific connotations. They think of it in a certain way, and a lot of times it's sort of a mental block from breaking the perspective to see the other ways that you can use it. So I hope to just share some of the lessons I've learned through my career trying to use these techniques. It's funny. I included this just to illustrate. Again, as a fan of visual analysis, I found looking at things visually is way more interesting than tabular form. So my resume in chart form is way more interesting because then you start to get the context. So you can see on the left, I started my career at Bloomberg, which was a great experience. Getting inside a lot of buy-side, sell-side shops across North and South America and getting to know traders, portfolio managers, analysts, individual investors, advisors that were using technical analysis day to day and helping them sort of address the challenges that they found trying to analyze the markets that they were working on. Fast forward to 2008, I was brought up to Fidelity in Boston, where I ran the technical research department, and then added a new associate program as well. And so, as I mentioned, my job was to work with portfolio managers there. And also I spent a lot of time traveling around the U.S. meeting with Fidelity's advisors through the advisor network to help them understand the challenges that clients were facing through the lenses of market history and visualization. And then as you mentioned, Tom, and thanks, I started my own research firm end of last year called Sierra Alpha Research. Sierra Alpha is a flight term. I'm a student pilot, and so it's slang for situational awareness, which is what I think charts bring to you as an individual trader, as an investor, is a situational awareness. And what that is when you're flying a plane, you need to be aware of what's going on around you. And a lot of times you can get caught looking at the clouds or looking at the ground or thinking about your flight plan, and you forget to just open your eyes and be aware of what's happening. And I found with investing, we do that a lot of times as well. So situational awareness is understanding what's happening in the cockpit and outside of the cockpit. And think of it as an investor, it's knowing what's happening to your holdings, but also what's happening in the investable universe around you. And you pointed out some of the charts like FedEx, the media names, home construction, some of those charts, if you're not taking the time to find those opportunities, you're just going to be holding sort of a sub-quality portfolio. So thanks for that. One interesting note on this chart, again, as many of us are technical analysts, you'll notice, unfortunately, a correlation between when I change roles and future market direction. So I'm hoping that is not what holds us in store. Now that I've made a change here, but I've always joked that there's a cyclical nature to my career and also the markets, and unfortunately they've aligned way too well.
Well, hey, Dave.
Yeah.
Going back to that chart, if you can, for just a second.
Yeah.
I noticed the same thing, and I'm a little bit superstitious. And so when I look at this huge bull market rally that we've had, I mean, I've got a lot of charts that I follow as to the sustainability of the bull market. But I wasn't aware of this one until today. And this is scaring me. I have to admit, this is scaring me a little bit. So what I did is I just called Fidelity and I got you your old job back.
There we go, right? For the good of everybody. Thank you.
I like 2009 to 2018. So we're going to try and redo that one.
Well, it's funny. They always say that, the market doesn't repeat itself, but it often rhymes. So we'll see. It's interesting, though. Some of the long-term work I've done for my clients is looking at, extended bull markets. And if you look now, you're looking at, 20 years of history. And a lot of times we get so caught up in the short term, especially now in sort of a consolidative period, we get really caught up in the flickering ticks and the day-to-day movements and forget to think about the long-term context. And so at Fidelity, we had a space called the Chart Room, which is still there. It's a fantastic physical representation of market history, huge wall-sized paper charts. And really a lot of ways, the purpose of that space is to help clients and portfolio managers really take a step back, a 30,000-foot view. Let me understand the long-term trends. And if you look at what's happened over the last 10 years, it's not unusual. If you look back at sort of the early mid-'80s, we had a similar pattern. And if you line up the 1974 low with the 2009 low, we're about 109, 110 months into this bull market, give or take a little bit. And trends can last much, much longer than what we've seen so far. So hopefully, even given the current firm structure for myself, hopefully we continue to see higher highs for the market. But thank you, Tom. So what I hope to do is just share with you, three features of technical analysis. And what I'd encourage all of you listening is, think about your own trading, your own process. And I bet you will find that with one or two of these, you have it covered. Like you're getting it, you're doing what you need. And then there's probably one or two of them where you're not paying as much attention. And I think that's where you can help yourself become more of a well-rounded investor and more of an aware investor in the markets. So, very quickly, the technical analysis has three features. Number one, it's descriptive. So it helps you understand, helps you define what's happening around you. The second thing, it is comparative. So it allows you to compare multiple things to each other. So some of the charts, Tom, you were showing, looking at relative performance of a group versus others, in particular, the autos, you're showing the auto makers struggling on a relative basis. That's one of the things that helps you get out of just the candle that you're looking at and think about, the big picture. How does that compare to other things? And then final technical analysis can be predictive, so it can help you anticipate what's coming next. And again, I'll go through some examples of each three of those features and encourage all of you to just think about your own process. So in terms of descriptive, I put a chart of the S&P 500 and just showed the symmetrical triangle pattern that I've seen, and that's using the highs from 2018 and the lows from 2018. You have this consolidation of higher lows and lower highs. And, a couple of weeks ago, we actually broke out of that symmetrical triangle to the upside, which for me was this first warning sign that, it looks like we're breaking out and happy times are going to continue as stocks rally. We went right up to that 2790 level, which is one of the horizontal pink dashed lines on my chart here, which for me is really the line in the sand. And until we break above that convincingly, it tells you we're still in a consolidation. So last week we traded above it a number of times, but closed down on both of those days, which for me tells you sort of an underlying weakness. But for me, the fact that it's a symmetrical triangle is less relevant than why a symmetrical triangle would happen. And in a lot of my career, I've spent time with fundamental analysts and fundamentally oriented investors trying to incorporate charts into their process. And for me, understanding why this chart would emerge is what's most important. So what does a symmetrical triangle represent? It represents equilibrium. It represents buyers and sellers, struggling to sort of define what something is worth at a certain point in time. But overall, we're revolving around that point. And if you look at the midpoint of the triangle, it's around 2,700. So over time, even though we've had a lot of volatility, and even though we've fluctuated, had a huge range, overall, we're sort of centering in on that price. And that's almost right about where we're at right now. So so for me, is there a predictive value to a pattern like this? There could be. And in some cases, I think it can be really helpful to know. But for me, it's more helpful to understand the behavior driving this. This tells us after a huge bull market, we've corrected a little bit, but now we're really starting to center into where people think stocks on average are worth. And when that breaks one way or the other, once we break above 2790, once we break below 2650, which would be one of the lower ends, lower lows that we've seen previously, that would start to tell us which side of the market is taking control. And that's the momentum we'd probably want to follow. Second feature I found with technical analysis is comparative. And this is, one thing I found with individuals in particular when I've worked with them, you get so caught up in analyzing a specific stock or ETF or industry, and you get really thoughtful about, how does what are the entry and exit points? How do I trade it? It's a breakout, it's a breakdown, but way more important than that, especially if you're in the equity space, is understanding how that one chart compares to all the others. Because a lot of times the analysis isn't the problem. The problem is you're looking at the wrong chart in the first place. So things like screening tools, ranking tools that allow you to filter through a universe and help you answer the question, what chart should I be looking at right now, I think are incredibly important, especially, as an individual, trading any sort of individual stocks, I would say it's crucial. So there's a lot of tools you can use to try and, compare one stock to another. Relative strength is one of those. So this is a chart of Seagate. It's one of the top in the scooter rankings if you look at the list in the large cap space. But look at how it's performed. So the line at the bottom is the relative performance of Seagate versus the S&P. And it had a period of underperformance in 2015, really a sideways sort of market performer in 16 and part of 17, and then it really accelerated. It's up about 40% in the last 8 to 10 months, which isn't bad on a relative basis. So seeing at the top, seeing that it's broken out of this big base, broken above 56, new highs, that's good. But seeing how much it's outperformed other stocks, I think, is even more important. The scooter rankings are one thing. That RSI is another tool that I've used for years. I really came upon the scooter rankings in the last year as I've started using more and more. I think it's fantastic. It's sort of if you're not familiar, it's a weighted measure of some of these different momentum techniques, trend techniques, and overall it helps you focus on what's working and what isn't. And in terms of situational awareness and understanding the world around you, I think that's really what you want to be able to do. So on my member page on stockcharts.com, I have this little object that I threw in there. It just shows me at any point, what stocks are really getting it done, and then I flip it over and say what's really struggling. And again, if you want to know what charts look good or what charts look weak, you can immediately use a mechanism like that and focus in on the charts to pay attention to. This is another table that I use. This is looking at the changes in the scooter ranking. So besides just the overall ratings, I like to look at what's changing a lot. And so as I was looking at this earlier this week, Best Buy came up on the list, and so I started to look at it. This is what I was mentioning in terms of interesting charts that are out there that unless you have a good way to screen for them, you might miss them. So here all of a sudden, and again, this was midday yesterday, I'm pretty sure it closed around the same level, around 70, but if you look at the top right of this chart, this is Best Buy with a bullish engulfing pattern after a 2-3 week sell-off. It's come down to a region, an area where it's had support before. We have this nice bullish engulfing pattern. That's kind of interesting to me. Looking down at the RSI, I can see the RSI got down to about 40, which if you're familiar with Connie Brown's book, which really talks about oscillators and how you adapt them based on the market trend. In a bull market, an RSI about 35 to 40 is where you'd expect the stock to find support. And that's kind of what's happened with Seagate if you look back over the last year or so. So the fact that it had, underperformed a little bit, pulled back, then a bullish engulfing pattern with an RSI around 40 seems like, again, maybe I don't pull the trigger immediately, but it's something I really want to look at a little further. And again, this tells me, based on all the other stocks out there, this is something that really has the opportunity to move going forward.
Hey, Dave.
Yeah.
What is the number one? I mean, when you're thinking about buying, what is the one thing that drives that decision to buy? Is it the RSI? Is it price hitting support? Is it the relative strength? I mean, can you talk a little bit about, once you find something that looks interesting like Best Buy, what is the one thing that really gets you to pull that trigger? Is it a false breakdown where you get that big rally back and, print a reversing candle, or what do you think?
Absolutely. It's a great question. And I would say, for me, thinking as an equity investor, when you have so many different things to pay attention to, for me, it's not just about one indicator, it's about a mosaic. And so it's funny, I wrote on my blog last night, I have a blog called Market Misbehavior, and I wrote an article talking about, some of the behavioral biases and how do you overcome them. And one of the ways you do it is by using checklists. So when I'm teaching technical analysis, when I taught in college, or when I teach junior analysts, I teach them to go through a very rigorous, very specific, emotionless checklist. And it starts with real basic stuff. What is the Dow theory trend? And, looking at the higher highs, lower lows, what are you seeing? Is it near any relevant moving averages? Are they sloping up or down? What are the key support and resistance levels? And then it gets down to things like price confirmation, things like oscillators, RSI, relative strength, things like that. And in the end, you have this list of points. Did it say buy or sell or hold or whatever? And once you've answered all those questions, then you can make an overall decision. So what I found is, as a starting analyst, as a starting investor, you tend to need to have those very listed out. And so honestly, on the wall of my office at the time, I listed out, here's the 10 things I want to check, 10 boxes I want to check before I would make a trade or anything, or make a recommendation. Over time, a good analyst or a good trader is able to internalize that checklist. And there tends to be a go-to thing. There tends to be a starting point. Here's the first thing I'm going to look at, and then I get confirmation from other things. So for me, for years, I've used RSI as sort of my initial confirmation. So I screen based on the RSI, look for stocks with an RSI below 30, RSI below 40. I look for things that are overextended, both on the upside and the downside. And once I see a stock like this with the RSI has pulled back to where you might expect it to bottom out, then I start to look at all the other things. Look at price. Here we've potentially seen a higher low. The bullish engulfing pattern for me tends to be a really powerful thing, because as a longer term investor, I'm thinking, months to years. Even though the bullish engulfing pattern is a short-term pattern, it tells you something about the short-term dynamics. And if you're trying to get in at a good price, that's the type of pattern that I like to see when it's pulled back to support, to a moving average or something like that. So for me, what would put this on my radar? It's something like the scooter rankings, or for me, for years, again, I've used the RSI as an initial screen. Then I start to look at the stocks that fit in that bucket to find the ones that have something like a bullish engulfing pattern, which would just confirm the signal that I saw.
Okay. Appreciate it. Thank you.
Yeah. One of the other ways I think about comparative analysis is through data visualization. And, I think if you think about the foundations of technical analysis, it started as a way really for individuals to have an edge over, wealthy investors and, the robber barons, the money managers that were able to do whatever they wanted, because fundamental data was not really widely disseminated. This is in the early 1900s. And so charts were really the data visualization, the business intelligence of the time in the financial markets. This was a way that you, as an individual, could see what something looked like and understand the supply and demand behind it. So in a lot of ways, technical analysis predates most other forms of financial analysis. And so I think as we have evolved as humans with greater use of technology, I think we've had the creation of some fantastic ways to visualize data. And I know Julius de Kempener was on recently, and he does a great job with the relative rotation graph. I've used his work for years and years, and I've loved seeing it incorporated into stockcharts.com, how it has been. What I've tended to do as a way to compare sector rotation, understand sector rotation, is just look at the last 2 weeks. So this is a weekly look at the 11 S&P sectors using ETFs here. And I'm just looking at this week and the previous week. And what I like to do is put the whole thing in motion and just see that rotation and see visually how I used to do it. And I was joking with Julius on the phone a little while ago. He told me that I was one of the first people to print out his rotation graphs and put them on my wall so I could flip through them and do a very rudimentary, not technology-friendly version of putting a chart in motion. And now I'm thrilled that you're able to do it very easily on the website. But so what I've seen here, and you mentioned some of this, Tom, with consumer discretionary, we've had this fantastic rotation over the last 6 to 12 months with these sectors. And if you go back over that period and use this visualization, you'll see some really interesting rotations. Technology has been one of the most interesting ones. So it had been the leader and up in the right corner for a long time, rotated down in the weakening quadrant, and now has come and gone full circle back to the leading quadrant. And that's even with the sell-off in Facebook and everything. Overall, this kind of smooths that out and shows you the overall trend. So that's been one interesting theme, has been seeing this market leadership in the upper right corner. Another theme has been energy, materials, staples. Some of these weaker movements in energy has really rotated hard down to the lower left corner and lagging. I think one of the things we're not talking about as much that I think is interesting here is utilities, real estate, telecom, some of the more boring, conservative, lower volatility parts of the market really starting to rotate higher. And I don't think that means you need to get into them aggressively, but I think it does tell you a little bit about a potential rotation to safety and potentially considering some of those for a little exposure. Besides the fact that obviously there's usually a good dividend component with a lot of those names. So it's in terms of safety and riding out a market correction, it's not a bad place overall. Finally, the third feature to sort of conclude this discussion is the predictive nature of technical analysis. And it's funny, this is where I think a lot of people immediately go to, whereas I think of it as sort of the third most important because there's so many different ways that you can use charts well. But I think if you think about the predictive nature, there's two things you can do. You can try to have a leading indicator and anticipate it, or you have a lagging indicator and you try to follow the trends. In terms of leading, something like an RSI, looking at momentum, so for example, this is Dow DuPont. This is when it sold off beginning of February. It became oversold. We had this bullish engulfing pattern. That's the type of anticipatory move. It tells you we've gone way too low, way too quickly. We're right at the 200-day moving average. All these things line up that tells you we're probably going to see a bounce. And sure enough, over the next couple weeks, we have the bounce we're looking for. Now what's happened is it's again come back. It's pulled back to around 66, which has been an interesting support level, also resistance from 2017. So it's sort of back on my radar as something I want to pay attention to. But overall, in terms of the predictive nature, the lagging sort of indicator will be something like relative strength at the very bottom. So overall, the trend has been lower. We've seen a pattern of lower lows. We, arguably are potentially near to a lower low right here. So if we would see that violated, that support, I think that would confirm that, Dow DuPont no longer in a consolidation, but really more in a breakdown mode, and on a relative basis has been very weak. Sort of the Newton's law of motion, object in motion tends to remain in motion. The best academic research looking at trends tells you that momentum works over the long term. Trends in place tend to continue. And so understanding that something's in an uptrend or a downtrend, as simple as that sounds, a lot of times can help you be on the right side or the wrong side of a market. And then finally, with the movement in Facebook, I had to include it in here, just looking at it earlier this morning. And the way I'm thinking of something like this, it's funny, it's very similar to Dow DuPont in terms of pulling back to a support level. So it's pulled back to the level of support we had last September. It's pulled back to the 38.2% retracement of the 2017-18 run. Again, we'll see how today closes, but as of the first 30 minutes, hour, it's a bullish engulfing pattern, which is kind of interesting to me. RSI below 40, and if you look back at when that's happened, that's been when Facebook's bottomed out. So again, in the short term, it's showing a lot of the signs of being extended to the downside after a couple really negative days. So I would not be surprised if we saw a short-term bounce here. Just to wrap up that, go ahead.
I got another question for you. Do you follow Wyckoff at all?
I don't, but I respect people like Bruce Fraser a great deal who do follow it. And so I know there's something there. And when I have talked to him about it, there are enough similarities, I feel like, with what I look at and how he would describe Wyckoff. So I feel like it makes a ton of sense from what I'm familiar with it.
Yeah, I know on Facebook, I mean, this is one of the more interesting stocks, I think, right now out there technically because number one, it really started underperforming the internet space probably 6 months ago, 5 or 6 months ago. It topped on a relative basis. So even though the overall stock continued moving higher up into early February and was still printing, new highs, then it had begun to lose its relative strength versus other stocks like Twitter, which has taken off and now seems to be a much better trade, at least from a relative strength perspective. But the thing that bothered me on Facebook is the last 2 days on this move to the downside. Now, it did come well off of its lows yesterday, which I think is definitely a positive. But the last 2 days volume on Facebook's been over 200 million shares, which if you go back and you look since the Facebook went public, from a dollar volume perspective, we're on pace to have the heaviest volume week ever on Facebook. And that, to me, is adding a little bit more of bearishness when I look at the chart. I was just wondering your opinion. You haven't spoken a whole lot about volume, and I don't see it on some of your charts. Is volume something that you consider in your analysis, or is it strictly based on price and relative strength?
It's a really, really good question. So the short answer is I don't use a lot of volume, and I've found talking with people that are Wyckoffeans, I think that's maybe where we differ a little bit. I did, as I learned the toolkit, getting the CMT and all of that, I learned about volume along with all the other things and did incorporate it into my work. I think what got me with where I sort of backed off of it a little bit was something like the example you shared with Facebook. I think you can start to draw some good conclusions about what bets people are making. And I think 50 years ago, if you look at the price moving and you saw volume increasing, you could draw a pretty direct correlation between increased volume and this must be big institutions accumulating shares or something like that, right? Because I think with volume, it's all about understanding what is causing the volume to increase. What got me was in the period of decimalization in the early 2000s when you had the issues with, instead of just looking at pit trading, now all of a sudden you're looking at a consolidated tape. Something like a traditional money flow measure, which for me was, as I was learning it, seemed really interesting, looking at tick data and looking at volume on upticks and downticks. But then all of a sudden, when you look at how the tape was actually being constructed and that upticks and downticks weren't necessarily new buyers and sellers coming in, it could be two hedge funds making a defensive position and exchanging shares or something like that. I found that the directional message of volume was muddier than I would have liked. So I started to use it a little less. But I am finding kind of what you alluded to. Day to day, I don't use it as much. When I see something like that and you see a spike on volume, you can really start to understand this is a capitulation of buying and selling, or this is a lot of people that are potentially, exiting short positions or something. I think there still could be a message there. So yeah, maybe it's something I should be using more than I have.
Well, I know I look, when I'm looking at your Facebook chart, I look at that low back in early December as possibly the left side of a neckline, with the move up in late January being the head, and then the big sell-off we saw in the second week of February being the right side of a neckline, the last move up being a potential right shoulder, and then a big breakdown on very heavy volume here over the last 2 days. Now, I do agree, today we are bouncing back. I'm really interested to see how Facebook finishes today, because it is putting in a really nice candle today, and the volume is not light. It is heavy again. So, again, I just feel like Facebook is one of the more interesting stocks out there because I could make an argument on both sides, but I don't like the relative strength on Facebook when you look at the other internet stocks.
Well, and so you hit on a really interesting point. I sort of labeled relative strength, relative performance or relative strength as a lagging indicator, but here you're actually showing how it can be used as more of a leading indicator as well. And especially when the market overall has been so healthy and the average chart has looked pretty good. If you just pick a random S&P stock or a basket of stocks over the last year, overall, they, before this correction have looked pretty good, right? I mean, nothing's looked horrible and some things have looked exceptionally strong. Relative strength is where you start to see what's not working as well relative to others. And a lot of times in a bull market, we sort of falsely pat ourselves on the back. When someone once said, don't confuse brains with the bull market. Just because your stocks are going up doesn't mean you're crushing it. That just means you just happen to be in one of the many names that are working. Relative strength tells you if you're really doing a good job of differentiating your trades or your portfolios from everything else you could be doing. And And I think that's where Facebook has shown some relative weakness. Even though the FANG stocks as a whole obviously have been an incredible relative trade, I think Facebook has been a notable, sort of weaker part there. And this sell-off has just been sort of the exclamation point on that relative underperformance. To your point, Tom, I think that's right.
Yeah, no doubt. All right, did you have further? Yeah, okay, you had.
Yeah, just to finish. I mean, the last thing I would say is I found, just trying to think of, some of the people participating. If you're earlier on in your journey of incorporating charts into your trading, I found people a lot of times sort of make mistakes with timeframes. And with portfolio managers, I've worked a lot with people running money and starting to incorporate charts into their process. And I found this is an area where people can tend to struggle. You need to think of, in my case, I think of the market in three timeframes. Short term, which for me is, a couple days to a couple weeks. I know for some of you that might mean, a couple minutes, which is totally fine. That's not the time frame I've tended to operate on. I tend to be a little more longer term. So for me, short term is sort of the swing trading window. Medium term is some months to a couple years, and then long term is beyond that. And if you look at the data, if you really dig into the data of what has happened with stocks for decades, this is what tends to happen. In the short term, stocks tend to mean revert. So a stock like Facebook, given what has happened, it tends to bounce up and rally. And that's why something like RSI has stood the test of time, because when something's overbought or oversold, it tends to correct in the short term. The chart of DuPont is a great example of that as well. On the medium term, if you look, 3 to 12, 24 months, markets, if you look at the data, tend to follow trends. So you are better served not betting on mean reversion, but betting on trends to continue. So if you look at a chart like Facebook, overall, there was a consistent trend. Now, if you look, at certain periods, there are times when it got overheated or got, pulled back to the 50-day, and you sort of, if you look on average, a couple weeks is about when that happened. But if you look at the 3 to 12 month trend, you had a series of higher highs and higher lows, and that's the Dow theory sweet spot, the midterm. The long-term markets tend to mean revert, and that's more in line with the business cycle and the cyclical nature to companies and the economy. So you need to think about, I think, when you're thinking about the tools that you put on your chart, think about what time frame you're trying to have an edge, and make sure that your toolkit is allowing you to capture what the data has shown actually happens. So for me, a lot of my clients, a lot of my work is with professional money managers, where they're looking sort of in that medium term range. So a lot of my work is on trend following, understanding the overall trends, and then using the short term as more of a tactical play to try to anticipate when we could add to positions or subtract from positions. And then at the bottom, it just shows you, I think using just charts and ignoring the fundamental drivers to companies can be a bit of a mistake. The longer term you are, the more you need to be aware, because the longer term stocks, I think, really trade to the fundamental stories. But in the short term, there's a little bit of that triangle left on the left side of the slide here, and that's things like, earnings dates, knowing the company is reporting earnings and knowing that that can be disruptive to valuations. That's good to know in the short term. And then my final comment for everyone is just keep it simple. And a brief story, if you'll indulge me. Early on in my career, I was on a trading desk in New York City. I was on the currency desk, actually. And I was walking, my job was to meet with traders and help them think about charts, and help them tweak their process. And I saw someone with a chart similar to this. This is a chart of Facebook with a lot of indicators and annotations on it. And as I looked at his desktop, he had sort of the cockpit, maybe, 5-6 screens in front of him. He had maybe 10 different charts, all with different indicators, all as busy as the chart I'm showing you. And so I had to say hello. I introduced myself. I said, listen, I'm a technical analyst, and how are you doing this? Because I don't know how you could use all these tools. This is fascinating. Can you tell me your process? And he said, you know what? I have absolutely no idea what any of this stuff means. He said, but the head of the desk will walk by and look at my desktop and say, wow, that guy is completely on top of the market. Look at him. So the moral of the story is, if you want to impress people by busyness and how complicated you can make it, by all means, do something like this. And something like stockcharts.com, you have such a wealth of choices to make in terms of what to use. But I think you need to be thoughtful. If you look at the charts that I've shown you with my own analysis, they tend to be relatively simple. It's a couple techniques and that's it. Because otherwise, I think you are opening yourself to the behavioral biases, things like confirmation bias, where you have an opinion and then you find a reason on the chart. You want the charts to tell you what to do. So my main plea to all of you using a powerful tool like stockcharts.com is just keep it simple and be thoughtful about what tools you're using and when.
One thing I wrote down earlier when I was listening to you, made a note, and I just jotted down analysis paralysis. And the reason I did that was Erin did a really good workshop on here a couple of weeks ago talking about analysis paralysis and how you can really be slowed down when you have too many choices and too many signals and too many things going through your mind. And then you begin to doubt yourself because you have 20 indicators and 16 of them tell you to buy, but then it starts going against you. And then you point to the 4 that are telling you to sell. And it's really hard to make decision. And the reason I wrote this down is that I noticed as you were going through your entire presentation, how simple your charts were. Which I think that's awesome.
True. It's true, and I part of that is probably because most of my career, if not all of it, has been involved talking to people who are not necessarily technically oriented. So I have to use things that can resonate with someone who doesn't understand charts very well. And so simplicity is the way that you make that connection. So for me, it's keeping it simple and then talking about the behavioral reasons why something happens. When Facebook's oversold, what does that actually mean? And why can you assume that the market's going to bounce a little bit? But yeah, you just have to keep it simple. I agree.
Yeah, and there's I know that there are as you pointed out in this last example here, where the fellow you confronted said he had no idea what the heck any of that meant. And we talk a lot on this show about understanding the indicators you use and understanding them well. I don't think it's a good idea to look at a chart and say, well, this line's pointing higher, so I'm going to take 10% of my portfolio and put it right in this stock because this line. I mean, that means nothing. You have to understand why that line's pointing higher, what it means. And more important than any of that, and I'm sure you agree, is you got to have a line in the sand because you're not going to be right every time. And so there's got to be some level where you just finally say, you throw your hands up in the air and say, you know what, I was wrong on this trade. And I'm going to take my loss, a smaller loss, and I'm going to move back to the sidelines, look for a better day.
That's right. I've often found as a technical analyst, my role has so much more value. It's less on finding the next great thing. It's not the next big home run. It's not the buy indications. It's more of the sell signals, which a lot of times for a fundamental investor, you have to admit that you are wrong. Here's a great story, great company, interesting catalyst for growth. I'm going to buy it. But when the chart goes against you, that tells you that it's just not the right time for that thesis, that something's broken. And as an investor, you have to admit, boy, my analysis was fine, but this just wasn't the right call. And, you are not going to be right 100% of the time. And I think the way you handle that percent of the time when you're wrong is what's going to help you, live to invest another day or find a different thing to do with your time. And so charts, obviously, I think provide a great emotionless line in the sand, if you will, telling you when you need to change position and just recognize that you were wrong. And admitting that is very, very difficult. We are not hardwired to admit our own faults, and especially as a professional analyst paid to tell people what you think. But you have to do it.
Yeah, and as a human, that's one of our negatives, is that we really do find it difficult to admit failure and to admit that we're wrong about something. It ends up costing us a lot of money. In many
instances. It's great, when you use indicators all the time, I always can point back to them. Well, the indicators said this, and apparently they were wrong, but I wasn't, just the indicators.
Right.
A little bit of something to go back on there.
To your point about learning analysis, the boot camp I went through, this is when I worked at Bloomberg, I went through and proved out every indicator I wanted to use in Excel with the price. I just had the price and I had to calculate them. And doing that, I hope you don't have to do all of that. I mean, maybe just read up on them because it was kind of a pain. But I tell you what, I something like RSI, I knew exactly what it was because I had gone through the effort. So something like the scooter rankings, for example, you guys do a great job of showing here's what the inputs are and here's what it means. And if you're not familiar with it, go look at it because I think that will help you make a better decision using the tool.
Absolutely.
I know we probably had a lot of comments in the room, Erin, and yes. We can forward those questions on to you, David. If you have a chance, maybe at some point you could respond to some of the questions that have come up in the room, maybe through email or whatever. But are there any specific, or is there a grouping, Erin? I don't know if you had a chance to look at them, but is there any one question maybe that was prevailing?
I think the one that was the big one was, the volume question. I think you answered that very well, David. So I think before we close out, though, you helped us come up with this poll for today. So I thought it'd be interesting to look at that before you head out. And
Fantastic. Yeah, thank you. And yeah, any questions, I'm happy. I had my email up there. I'm more than happy to answer them. And thanks everyone for listening. I asked, if we could just get a quick straw poll on what people thought. It's interesting that over half of the respondents said we'd be flat to up 5% in 3 months. And then it was sort of even between the other three. Now, the reason why I wanted to do this poll, when I taught my course at Brandeis on technical analysis, Brandeis University outside of Boston, the first day of class, I would always ask people, where do you think the S&P will be at the last day of class? And everyone would submit their answers, and then at the end, I'd give a prize for whoever was closest to the correct answer. What was interesting, though, is the one time I did it, this was a number of years ago, but the top respondent, the highest answer was up about 45%. The lowest answer, someone said it would be down about 25%. So I had a huge range from the highest to the lowest. So individually, people were not very close to the pin. As a class, we ended up about within 0.5% of where the S&P actually closed. And I think that is an interesting illustration, and potentially we'll see that here. Individually, we make a lot of difficult decisions and poor decisions because of the biases, the emotion that we derive our decisions from. But as a group, as a market, we tend to be a pretty good judge of what something is worth at a certain point and where things are headed. So as a group, we've sort of unscientifically decided the S&P will be flat to up 5% in 3 months. So that'll be interesting to watch to see how it plays out.
Where would you put your vote?
Great question. I actually didn't have a chance to vote because I wanted to make sure I was doing everything right for all of us here. But I actually would put myself in the from -5% to 0% probably. It's funny. Anytime I'm asked, "Are you bullish or bearish?" you catch how people ask that question. They don't give you a third answer, which is kind of in the middle. They say, "Are you bullish? Are you positive or negative?" And I think if you look at like the AAII poll, the neutral ratings, I think are interesting to look at because it shows you who actually is in the indecisive bucket.
yes.
And for me, I think that is that third direction that is incredibly frustrating because we can have plenty of volatility, but as a long-term investor, you're really not going anywhere. What's good is I think that will open the opportunity for a lot of differentiating for stock picking because even though the market might be flat, there will be stocks like ExxonMobil that are getting beaten down. There will be stocks like Twitter that are continuing to break out and everything kind of in the middle. So as a technically oriented stock picker, I think it's going to be a sweet spot, even though I think the market, right about flat to down a little bit is probably about right. But we'll see.
I'll tell you what, I'm going to put my vote in right here, but I'm going to do it with an asterisk. I'm going to say,
Of course you are.
Is that allowed, Tom? I don't know.
I always have an
Not.
asterisk. All right, so this is what I think. I think that the S&P is going to be up 0 to 5%, but I think it's going to wildly underperform the Russell 2000. I look for strength in small caps. I think on a relative basis, small caps are starting to outperform. I think the dollar is starting to regain strength. And one of the things the S&P really benefited from in 2017 was a rapidly declining dollar. And I think the dollar is going to be flat to up, probably up in 2018. And that, I think, will bode better on a relative basis for the small caps. So if this said, what are the small caps going to do over the next 3 months, I would have been in the over 5% camp. I think the small caps are going to run.
Mm-hmm. Well, we're talking about the S&P 500.
Yeah, I know. I didn't put the poll together, so I can't, I guess, use an asterisk.
Yeah, exactly.
Hey, it was great. It was great having you on for your presentation, but I know you're going to be with us at ChartCon, David.
Absolutely. I'm very, very excited to come out there, excited to participate. I'm going to be doing a presentation called The Mindless Investor and the Mindful Investor. So, my background is a lot of behavioral finance and addressing behavioral biases. So what I hope to do is just help people understand, using mindfulness techniques, as I got into meditation and more mindful ways of living in the last number of years, I found so much good relationship between the techniques I was learning and how to be a thoughtful, well-rounded investor. And just we'll talk about, how to learn from your past mistakes, how to be present in the moment, understand what the market's doing, and also have a good game plan for the future when things go against you. But yeah, excited to do it. I'll be bringing my family after, anyone that's coming in for the cruise after. I'll have my wife and our two children, including my 2-year-old son Henry, who should be a lot of fun on the cruise. So we'll see. Look forward to seeing people there.
Absolutely. I'm very excited about the VIP. We've only got till March 31st, though, for you guys to sign up for it. And A lot of you take summer vacations. So I think this would be a great one. You can bring your significant other and take the cruise after. I think it's a great deal for a summer vacation. And you get the bonus, of course, of hanging out with all of us. And you can sit down and talk to us over your favorite beverage, and we'll have some fun.
Hey, and the other thing, I was thinking about this earlier. Of course, we're getting close to tax time, so of course my CPA background is only leaves me for so long. But work with your accountant, because this is an educational type of deal to come out to ChartCon, and so you might be able to swing a 7-day cruise, and write it off as education. Just saying.
Yeah, that's pretty tricky. And then, of course, it is an online conference. So as I was showing you, you can register. If I can find the little register button, register now. Well, it's taking me right back down there. But it is about $200 for the online version. And while that may seem kind of pricey to some, you get all of those presentations, in live stream, and you can go back to them and you can watch them and rewatch them. You can watch us live if you can't be there when we're doing presentations. It's similar to how you do it here at Market Watchers Live. So I certainly think that it's for all of you who come into this show a lot, that I can't imagine why you wouldn't do the ChartCon online.
Yeah, and if you can go back up to the presenters for a second, Erin, the schedule that we have. Yeah, right there. Stop right there. Okay, so this is a little bit of a I'm not sure what the right word is, privilege or something, Dave. But Chip has put you in the second game of the doubleheader. He's got you as leadoff hitter.
That's a good spot. That's wow. And I'll remind Greg, that's where I was put in there. Okay, that's good. Good to see.
Yeah.
You're the leadoff hitter, and we got Julius at the very bottom. I think we got Julius as cleanup.
Yeah,
wrap the whole thing up.
There you go.
So anyway, it was great having you on here. A very, very informative session. Really appreciate you coming on, and we're going to get you back.
Oh, it's a pleasure, Tom and Erin. Happy to be on anytime. And look forward to seeing you guys in Seattle soon.
All right,
excellent.
Wow, that was excellent. That was a great presentation. I really enjoyed listening, and I think everybody watching probably could pick up some pointers from Dave on different ways to approach their trading and strategy. And it was enjoyable to listen to, for sure.
Absolutely. And we are starting that 10 and 10 late today, but we are going to do it.
Okay.
So let's go ahead and get it started. Here are I'm sharing my screen, correct? Yes. Okay. Let me make sure I'm on the right page here, though. There we go. All right. So these are the 33 that we got. And I'm going to put those very quickly in RRG, just so we can see how their rotation is going and where they are as far as leading or lagging in the very short term. And there we go. So the ones we want to look for, if you do an RRG, you're looking for those northeast travelers. That's telling you they're improving and going in the right direction. It's interesting for what is in the improving category, but the main one is just looking at some of these directions. I don't use this to pick all of our 10 and 10. In fact, you've got just a few more seconds to put in to like some of the symbol requests that are in there. I'm going to put the most popular request at the top after you finish doing SkyWest.
All right, let's get into it. And I'll tell you what, I'm going to challenge myself to do 10 in 5.
Ooh, this should be
all right.
fun.
This is going to be quick. All right, so SkyWest here, we are trending higher. I see an ascending triangle, equal highs, rising lows. We've broken out with increasing volume. Volume maybe is a little bit of an issue for me. It's still okay, but kind of borderline on a liquidity issue. I like to have stocks that trade at least 200 to 300,000 shares a day on average. But we've got the breakout. We've pulled back. We've had price support. I think SkyWest looks good.
All righty. Look at you go. How about Apple?
Apple. Well, Apple doesn't fall far from the technology tree.
Oh, gosh.
Sorry. I would be watching the recent lows here. That, to me, is pretty important. I'm really surprised that we fell back below the 20-day moving average on Apple. But the selling that we've seen here recently, especially these last couple of days, starting to dry up a little bit. And I do think we've got a pretty key area of short-term price support around 172.5 and the 50 days right there as well. So that's an area where I'd like to see the stock move back higher.
Excellent. Let's do Skechers, SKX. And the person was talking about accumulation on this.
All right, I know I've looked at Skechers in the past, and I think Skechers does well on a seasonal basis early in the year, and I think Nike does better later in the year, from what I recall. I think Nike is really good, like in September and so forth. But anyway, looking at this chart, I think that off of an uptrend, we are sideways consolidating. That's a pretty significant uptrend from 24 up here to about 41 in about 3 or 4 months. So you got to give, I know it's probably frustrating if you've been in it, but I think you got to give this stock a little bit of room. And that is the trading range for me at this point. So I'm going to say 37.5 to 41.5. What we're looking for here is the volume to pick up and a breakout above that 42 level.
All righty. The next one is going to be PPC. Let's see. Yes, Pilgrim's Pride and Consumer Staples.
Yeah, Pilgrim's Pride, I mean, off of this downtrend, higher PPO with the lower price. So I'm just going to highlight that we did have a positive divergence in here. So there's your price moving lower, and here is your PPO moving higher. So what that normally means is that when you've got your 20-day moving average acting as overhead resistance prior to a positive divergence, once you get the positive divergence, what I'm looking for is a move through the 20 and to test the 50. So I think this one's got a shot maybe to go up to the reaction high around 27, which would give you that 50-day test. But if you fall back and lose $24, I would be really careful, again, especially if the volume picks up.
All righty, let's see. Next one I've got is the financial ETF, XLF. A lot of interest in that one today.
Yeah, well, there should be, because we've got a big interest rate announcement coming up here in less than 1 hour. And financials are clearly an area that is impacted heavily by interest rates. So I think it's worthwhile taking a look at. I just think we're consolidating with the XLF. I think a lot of what Dave Keller just talked about, you can see that we're consolidating. We established the high, we established the low, and now we're just in this range here for a period of time. So I eventually look for rates to go higher, and I think the XLF will break out and be a solid performer relative to the S&P 500. But for now, we're sitting in the middle of the range. Let's wait and see. Probably it's going to take the 10-year Treasury yield breaking out in order to get the financials to break out as well.
All right. Next one, the solar ETF, TAN. And it's just now connecting to me that solar and TAN. I can't believe I didn't pick up on that one a long time ago.
Let's see. Well, yeah, the renewable energy space has been doing really well. Of course, it had an awesome year last year, but it's been consolidating since it reached a high in 2018. We pulled back, kind of tested that low, although I would draw the big support, major support down just below 22.5. Short-term support's more around 24. I doubt that we're going to lose that 24 level. I think we're going to head back up and test this 26.5, 2660 area on TAN. I like the group. PPO is starting to accelerate to the upside, so I think it moves higher.
All right, next one, Coherent, COHR.
Yeah, this one had I thought it had a big day yesterday. It was a different one, I guess I was looking at. I think that the gap resistance, we've been on this downtrend. You can see the very, very heavy volume that came in the second week of February. That normally, when you gap down like that and continue moving lower, normally that is going to be an area of resistance. And the prior low over here on an intraday basis also was the high after we gapped down on this intraday. So I think this 227 to 230 area, really important. There's a bearish engulfing. Again, that's one of the things David was talking about. He uses the candlesticks, and that would have been an area I would have been looking for a reversal. We got a reversing candle and started moving lower. I think we're stuck in this fairly narrow trading range right now between about 204 and 230. Let's see which way breaks. My guess with the volume trends is that we're going to break to the downside.
Okay. Next one, Home Depot, HD. And talk about a textbook descending triangle here. And that is a bearish formation, so beware.
Yep, it is. I do like the divergence starting to turn up, though, here, as you can see, off of these lows. So maybe this price support, and remember, if this was a long-term chart, I'd have big problems, but it's a short-term chart. And if we move in and look at a longer-term chart, I think you see a much different picture with Home Depot. At the most recent high, PPO was rising. I'm actually going to annotate this one because I think this consolidation on the longer term chart near the rising 20-week moving average for me is actually more bullish. So here was the low established on the first test. I think if we hold 174, 175 on Home Depot, I would actually look maybe for a cup to form. So I'm a little bit more bullish on this one, even though I agree on a relative basis over the last couple of months, Home Depot has not been a great place to be.
Correct. I like that. So the next one is for our Canadian friends, Just Energy Group, JE.TO. It's utility and doesn't look that good to me. And I don't, considering the fear factor going on, we're not seeing anything here.
Yeah, I'm going to say watch the falling 50-day moving average, and then also watch the rising 20-day, because I think that the volume that came in recently has the potential to turn this chart around. Although when you look back over the last more than 2 years, we have been declining while the market's been going up. So if you're trying to outperform the S&P 500 or a benchmark index, it's going to be difficult to do it with this stock unless we start to trend higher. Right now, we got the PPO rising, but I think we're squeezing in between these two moving averages. Let's see which way we break from this.
All right. Final, Rio Tinto in the general mining materials, RIO. Looking interesting.
Yeah, this one looks pretty good. That weekly chart I thought looked pretty good. Let's move on to a daily chart. Yeah, I think as long as this support around 50 and a half to 50, 50 to 50 and a half holds, I think we're just consolidating off of those recent highs here. On this pullback, you can see that we did come all the way back down to the center line on the PPO. And even though we've gone negative on the PPO now, we are still holding on to price support. So I think this is another one that's in a range. And you could even go down this intraday low. Let's say from 50 up to 57 is the trading range. We're sitting at 53 in the middle, but it's all coming off of an uptrend. So I would expect that this will eventually break to the upside.
All right, that's 10 in 10.
I did it in 10. I didn't do it in 5.
Yeah, that's pretty good. And I'll make it a quick market update because we do have a lot of questions to answer for our mailbag segment. So with that, you should be seeing those symbols. I'll have those up in the Market Watchers Live chart list, and you'll be able to find those with Tom's annotations shortly after the show. And let's get on with our next thing. I'm going to do the market update, and then we'll get into some mailbags. So I'll get that screen back. All righty. Here we go. What's been going on while we've been talking? Well, it's really interesting to me. We've had this, it wasn't a great start, but we took off as far as the markets were concerned, just before the show start. But we're now pulling back again. And I suspect it has something to do with this Fed announcement getting ready to come up. NASDAQ is higher. Look at the Russell 2000. It opened higher. It never opened lower as the other indexes did. And it's managing to, it is pulling back, but it's still holding on to a lot of gain right now. TSX, a similar pattern, higher, pulling back. Everybody seems to be pulling back right now. Treasury yields are up, reading to 905 at this point. UUP gap down, but starting to head back up. Looks like it's picked up, gained back about half the losses so far. Commodities are higher with a gap up, but pulling back. USO, of course, doing the same. Gap up. Does look like might be forming a little bit of a flag here. We'll have to see what happens between now and the end of the close. GLD, gold, is higher, gapped up. It's pulling back just a little bit as the dollar starts its rise. The VIX is moving lower. We're now looking at VIX reading of 17.2. TLT, Treasury bonds are, they're down. They made that attempt to get in the positive territory, but have pulled back already. And that's all I'm going to do for our market update. I think we should move on to our mailbag segment. And get up here, and we will play. Okay, I got my screen back. All right, we're good. Okay, so we did have a couple of questions. Tom and I ran through some of them, and we'll see how far we can get before the end of the show. But I think we've left plenty of time here, so we'll have to see how it goes. So the first question, what blogs do you two read from outside sources? I can tell you my answer is honestly none. I just read the stock charts blogs. How about you, Tom?
Ditto. I mean, I'll read articles. Sometimes I'm over at Bloomberg in the morning, pre-market, looking at some of the news. Personally, for me, I find Bloomberg to be a little bit more objective, both in their print and also on TV than CNBC. So I tend to maybe look at some of the stuff on Bloomberg, but not really following anyone's particular article. I mean, as I said, I'm fairly, for the most part, I'm self-taught, but I am heavily influenced by John Murphy's work. So, of course, I'm going to follow the market message and things that he writes. And I normally read the articles in the Chart Watchers. I read everybody's article. During the week, I don't always have time to read everyone's article, but if somebody's article catches my eye, I'll pull it up. So, but I would say, 100% of my blogs that I read come right here from Stock Charts.
Yep, I think the only exception I could say is that we do have a top advisors corner on Stock Charts with some regular contributors there, like Tom McClellan, and so I will click on some of those blog articles now and then, but typically I don't, have a service or newsletter service or anything like that, because I think we have the best stuff here at Stock Charts. So, all right, next question we have, what are your favorite books on technical analysis? And I know for a fact, Tom, this is your favorite. Am I right?
You are correct. That is kind of where I got started. I try to look at the markets and come up with my own feelings on it, but I just found a lot of John Murphy's work on relative ratios and looking at various asset classes and so forth in trying to predict the direction of the market. It's not so much, trying to pick individual stocks. It's more about just that big picture. And I think Martin Pring is kind of in that same general mode. I think those guys have a knack, and they've been kind enough to share how they look at the market over the years. And so those are the ones that I would be most interested in.
Yep, and I figured that because that's how I ended up putting it in John Murphy and right into Martin Pring. And one of the things I didn't know about is that Martin has a study guide for his book, Technical Analysis Explained, and I'm actually thinking I might get that just to get a nice refresher. As far as other books that I would recommend on top of those that Tom recommends, I just think the world of Dr. Alexander Elder. I've followed his work for a while. He's, he knew my dad way back when. So I learned a lot from him, and his books are really easy to read. He was a psychiatrist, so he gives you the behavioral trading and all of that. So I think that's a great book. Of course, Greg just released Stock Charts for Dummies. If you need to learn how to, use the site and how the charts, what we do at Stock Charts, I think this is an excellent book. And then finally, I'd recommend, if you really want to get into it, study the material from the Chartered Market Technicians Association. They've got the new curriculum here, but I can tell you, if you want to get a deal on the old curriculum, it's pretty much the same as the new stuff. You don't have to take the test, obviously, but the amazing resource for information on that. And let's see. Do you prefer EMAs or SMAs? So exponential moving averages versus simple moving averages.
I prefer both. I use both. In fact, I get this question a lot. Why do I have a 50-day SMA and a 20-day EMA? And I would just say that an EMA weights the most recent data the heaviest. So, if you're looking, for me anyway, if you're looking at a short-term moving average, I'm more interested in the more recent data. So I use that as an EMA. A 50-day moving average, if I'm going to weight a longer-term moving average toward the more current data, then I'm not really looking at a long-term moving average. So it's just my own personal preference. I don't see too many folks who look at it the way I do, but I'm weird.
Yeah, you are. No, no, I think that makes perfect sense. I prefer just using the EMAs, mainly because Decision Point's trend models are based on them. So we do want to get the most recent, we want to weight the more recent data heavier because we're looking at signals and the crossovers. So for me, I use the EMAs and I use them on my weekly, my monthly, all of them. So.
And I would say too, I've not done any kind of scientific study, but I would say looking at charts of those who, use technical analysis, I would say that the overwhelming majority use EMAs.
Absolutely. Let's see. Next question. What do you do about earnings forecasts? For me, I don't follow them at all. So, that makes it easy to answer that question. I mean, I don't look them up and plan on them, and it just doesn't come into my my analysis process.
Yeah, forecasts I take with a grain of salt. I mean, I think if you have a management company that continually exceeds their forecast, then I think you can use those forecasts to get a good sense of where the direction of the stock is going. But I don't know that I trust too many managements in terms of using a forecast to decide whether or not I want to buy a stock. Now, what I will use is their actual earnings. When they come out, if they can beat their top line and bottom line estimates that they've provided to Wall Street, I think that's a great sign. I think it's a sign that they are executing their business plan. And so those stocks, for those of you that follow me, know that I keep a strong earnings chart list. And those companies that beat top and bottom line and also have strong technical charts, I put in that list. And some of those companies, by the way, lower their forecast going forward. They come out, they beat top line, they beat bottom line, and then they lower their forecast. And if the chart, given all that information, stays relatively bullish, I'll still use that in my strong earnings chart list. To be honest, as long as they're beating their estimates, I find the lowering of their guidance to be, somewhat honest going forward, and that's why they probably beat from time to time. I'd much rather have a company beat top and bottom line and give you a weak forecast than to miss top and bottom line and give you a strong forecast, because I'm not so sure how much I can trust that forecast.
Yeah, absolutely. Let's see. Next question. Would you take a possible shooting star candle as a serious downside? Downside. I don't actually use the candlesticks much, but I know I would look at it that way in the very short term.
Yeah, I think it depends on how it shows up. I mean, you can have a shooting star candle essentially is an upside down hammer where you've got a gap up. So you do require a gap up, and then you trade higher in intraday and then come back down and close near the open, leaving that candle body very small at the bottom with a long tail to the upside. So it just means that whatever strength you had earlier in the day has reversed and come back down to the downside. And yeah, I find that to be very bearish in certain circumstances. Number one, after an uptrend. So if you just got one in the middle of a chart that's been going sideways for many weeks, it means nothing to me. It means absolutely nothing. But
Right.
if you've got a stock that's been moving higher, and let's say it's approaching a high from 3 or 4 months ago, and you get that shooting star candle where you've got a breakout intraday above those prior highs, and you come back down and fail to hold that breakout, that's very bearish to me. And if you happen to have a negative divergence on the chart at the time of that, then that just adds to the bearishness in my view.
Absolutely. Yeah. With all candlestick formations, you do have to think about, you have to look at what's happened the prior day or two, because that affects whether it's a useful candle or not.
Yeah, and there's a psychological component too. I mean, if you've got the market breaking out or a stock breaking out intraday, from a technical perspective, I am only going to be considering getting in on that stock on a breakout. And I think most technicians would be doing the same thing. So why does it fail? Well, it fails probably because there's an overhead supply that market makers have, and they are distributing shares while everyone else is buying. And that is normally not the side of the market maker you want to be on. You usually want to be on their side, not on the other side.
Absolutely. And we did actually, it's funny, we got this question right now in the chat room. What's a CMT and how do you get it? Why would you get it? As I noted there, it is from the Chartered Market Technicians Association. You can get it here at cmtassociation.org or very easily mta.org. And it's a professional development program. You can learn more about how to get your CMT letters after your name. It explains all of that. So go check it out. I think if you're in the business, of course, it's always nice to get those extra letters after your name. I'm working on it. I'm on level 3, but I have to say I've learned a great deal just by going through this program. And when I get the time, I'll see if I can't get through level 3. not a lot of time lately. I don't know why. So let's see. What's our next question here? How do you find archives of the show? Okay, well, this one's mine too. I would say your best bet is to go to right here under blogs. And if you go into our Market Watchers Live blog, this is the best place. First of all, there's where our chart list is with all the 10 and 10 right there at the top of the blog. And you can read any single article in the MWL recap. And at the very bottom, well, right here, ta-da, you can get to the Facebook page. There's the YouTube channel. The YouTube channel is great because we, not only put down the title, but we also give you the, stop. So that's how you can get to that. And so that would be that final. Let's see, what's our next question?
Maybe one more.
Yep, I think we have time I think we're almost to the end anyway. Is there any value in limiting the seasonality range to a current bull trend that has started in 2009?
This is an interesting question, but I always find, I guess this is the math side of me coming out and statistical side. The more data you have, the better, the better your sample size is. Or
right.
I think it's very difficult. I mean, I could look at last 3 years and try. Gets a little bit back to what Dave was talking about during his presentation. When you're trying to pigeonhole something to look a certain way, you can always find an indicator to support your thoughts. And I think the same thing goes with seasonality. I could look at seasonality and say, well, over the last 20 years, this particular index doesn't look that great in March. But then I pull up the last 6 years and it's done really well. And I say, well, let's just look at the last 6 years. I think the more data you have, the more representative that sample is of the population and what you can expect going forward. I hear a lot of folks talking about, for instance, presidential cycles. I'm not a big fan of presidential cycles. I think there's probably some correlation depending on, whether you're in a second term and which year. There's probably some. But if you think back, how many times do we have a president that's in his second term and in the third year of his second term? I mean, you go back, and what have there been? Maybe 5 over the last few decades or something like that. I don't think the sample's big enough. I'm not going to put my portfolio to work based on something like that. So, yeah, I mean, you could create anything you want. I think just as important as looking at the absolute seasonality performance is looking at the relative seasonality performance. In other words, finding stocks or industry groups that tend to perform better than the S&P 500 over certain periods throughout the year, and then also understanding reasons why that's the case. A good example for me, I think Amazon tends to perform extremely well in September, and I think it has something to do with back to school. Same with Nike. So you're going to see seasonality, but I think when you can back it up with some other information, I think it's more valid.
I know that one question, I know we're down to the end, but I just wanted to say, you guys always ask about the difference between the PMO and the MACD PPO, and I've explained it very well in the Decision Point blog in my February 1st, 2018 blog, so I recommend you go check it out. And with that, I think it's time to close up this show. We'll look at what's happening. Friday, Tom has got his workshop, Reasons to Sell. And I happen to know, I think tomorrow we do Anatomy of a Trade. So that'll be interesting on Thursday. And that's pretty much it. Boy, busy day. David was absolutely excellent. I think I'm going to go back and listen to the presentation. I was doing so many other things behind the scenes, and I really want to hear more of it.
Yeah, a big shout out to David Keller for coming on. Really appreciate it. I thought he did a great job as a special guest today, and we'll certainly have him back on. As you can see on your screen, take the How'd We Do survey, which is located below the chat box. We'd love to hear what you thought of David's presentation today, and also what you thought of Market Watchers Live in general. Again, want to thank everybody for being with us today. Please remember to complete the survey as you exit, as I just mentioned. Because we do really like to get your feedback. I know I look at the feedback every single day. I know Erin does as well. So it's a great way for you to share your thoughts about the show, and really helps to initiate some changes in the show as well. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody. We'll be back here on Thursday. And remember, the Fed just about 30 minutes away. See you back here tomorrow. Happy trading, everybody.